Hey listeners, it's Paul Andriola here. Why not join our community at Small Cap Discoveries, where we offer our members direct access to some of the best microcap investment opportunities available. Our members are getting access to premium microcap financings, research reports, and direct access to management. Sign up today at www.smallcapdiscoveries.com.
Hi, everyone. Welcome to the Small Cap Discoveries conference call. Today on our call, we have the CEO, Duncan from CWC Energy Services. CWC trades on the TSX Venture Exchange under the symbol CWC and on the OTC under CAWLF. The company is currently trading at 27 cents with roughly 510 million shares outstanding, or about $138 million market cap. I'd now like to hand it over to Paul Andriola.
Thanks a lot, Trevor. Yeah, as most of you know, we've been pretty excited about the energy service space now for some time, and it's great to have another group that's in the middle of things or in the front lines of the space. So Duncan, thanks for joining us today. We're here to listen to find out as much as we can about CWC. So I'm just going to hand it over to you and let you start your presentation.
Great, thanks, Paul. Thanks, Trevor. So you're here I'm the president and CEO at CWC Energy Services, and you're here to listen to a presentation about CWC. This is the presentation I'm going to go through today is on our website at www.cwcenergyservices.com, and it's the latest one that we have posted on May 2nd. So first things first, forward-looking statements. Our lawyers suggest that I need to caveat everything I say about the future, but I keep telling our lawyers that I am of Chinese heritage and we did create the fortune cookie, so I might know a little bit about what I'm talking about. Okay, so let's start off with a quote. The Calgary Herald had called me back in February, about 6 weeks into 2022. And I kind of gave them this quote and they kind of used it in their newspaper. At that time, it was 6 weeks. That's why I've got 17 weeks in brackets here. But the first 17 weeks are now more like 23 or 24 weeks of 2022 have been fantastic. Every available crew that we've had on our rigs is working. If we had more crews, we'd have more rigs working. And I think that rightfully sums up what 2022 has been for CWC. In the drilling rig and service rig sectors, as well as generally the oil field services sector. It's been a very good year so far, and I anticipate that it will continue to be this way for the remainder of this year and going into 2023. So a little bit about the company snapshot. As Paul had indicated, or as Trevor had indicated, we have about 110 million shares outstanding at around at that time, when I did this presentation on April 29th, it was trading at 29.5 cents, gave us about $150 million market capitalization. Our debt level, excluding our real estate mortgage debt, is about $36.4 million as at April 29th, which gave us an enterprise value around $187 million. We anticipate that our EBITDA is going to be about 32.4 million. That's actually on the low end of the range now, as we have a couple of months under our belts here in Q2. And so we are now believe that we are going to have a range around 32.5 to $37 million in terms of adjusted EBITDA. So that gives us roughly a EV/EBITDA multiple about 5.8 times, and I put in terms of that EV/EBITDA multiple of previous years, back in 2014, before any of the downturn in the Canadian energy sector and oil field services sector, we were trading at 5.4 times, and last year, in terms of our EBITDA and our contribution, we were trading at 6.3 times. The tangible book value on this company is roughly $176 million, which gives it about a 35-cent tangible book value on a basic basis. Insiders of this company own 64%. We have one very large shareholder that owns 57%, and that would be Brookfield Asset Management. And the second large shareholder in CPPIB, so the Canadian Pension Plan, that owns 17% of the company. Trading range has been between 11.5 to 29.5, or sorry, around 30 some cents now over the last 52 weeks. And we did have an NCIB in previous years, but we currently do not have an NCIB, and I'll talk about why we don't have an NCIB here a little bit later in the presentation. So I'd like to talk about what we believe is going to be our growth for the next couple of years in terms of the acquisition that we made here in November of 2021. We acquired 10 high-spec triple drilling rigs and related equipment and inventory for $17.3 million US, roughly 21.4 million Canadian, in Casper, Wyoming. And we used our expanded credit facilities to do that. So we didn't raise any equity to do that. We believe that we bought these things at a fantastic price. To build these 10 triple drilling rigs today would cost about $251.4 million. So we bought it for roughly 8.5 cents of replacement cost of these 10 triple drilling rigs. The acquisition doubles the number of drilling rigs that we have in Canada and the US from 9 to 19 drilling rigs. And they're comprised of 7 heavy doubles in Canada, 5 AC triples, 5 DC triples, and 2 heavy doubles in the US. Essentially, we bought these rigs at just over $2 million a drilling rig. And for 2022, the adjusted EBITDA from our US division is expected to generate $12.5 million, which then basically gives us a purchase price to EBITDA of 1.7 times, which in any metric is a fantastic valuation. The operating areas in the US where we're going to operate these rigs would be Montana, North Dakota, Wyoming, Utah, Colorado, New Mexico, and Texas. So all of the relevant basins for oil and gas in the United States. A little bit about the summary. Last year, our production services division with 143 service rigs in total, but 65 being active that we've registered with our trade association, contributed roughly 69% of the revenue and 75% of the EBITDA. Because we bought these 10 extra rigs, which now makes us 12 rigs in the US, including the 2 that we brought down in 2019 and the 7 in Canada, our 2022 estimate is going to be a lot more even in terms of the split between revenue and EBITDA. So it's still weighted a little bit more towards the production services side of our business as opposed to the drilling side of our business, but it's roughly now 50-50 on both sides from a revenue and EBITDA contribution perspective. So where do we work? We're right across this basin in all of the relevant areas in the Western Canadian Sedimentary Basin, as well as in the United States. We have our head office out of Calgary, as well as the US office out of Denver, but our operating location in the US would be Casper, Wyoming, which is right in the middle of where that Powder River Basin is, and it's kind of right in the middle of all of the drilling activity. So a little bit about our drilling rigs, 5 AC triples, 5 DC triples, 9 heavy doubles, 7 in Canada, 12 in the US. We have one of the most relevant fleets in Canada and the US operating in these basins. The depth ratings of our rigs go down to about 7,600 meters, which as people know would be very capable rigs in terms of the depth levels that the rigs can go down to. We've broken it out simply from a decadent perspective, which is really just hook load in terms of pipe handling capacity as to the type of rigs. So we kind of just use these classifications and called them the Cardium Basin, Montney, the DJ Basin, the Powder River, Bakken, and the Duvernay, Permian, Eagle, and what those decadents are. And you can see the number of rigs that we have relevant to each of those basins. All of our rigs have top drives, which is a good thing, which is kind of required from our customers' perspective. 7 of those rigs are pad walking rigs, so can move on its own without having to move the center section and mast with trucking capabilities. 9 of them have 7,500 PSI pumping systems, which is the circulating system that we would need and is being more in vogue and being asked by our customers more often these days. 3 have, from an ESG profile perspective, biofuel capabilities, meaning we can switch from diesel to natural gas. And 2 of them have highline power capabilities, which means that we can use electricity on the rig if there is a highline power power line close to where the activity is. Wanted to show this 5-year rig count graph. So the dark blue line here is the 2022 activity, and this was taken from Stifel's presentations that they have on a weekly basis, and it was done on April 26th. The dotted blue line would be the 2020 timeframe, and then the gold line would be the 2021. You can see that 2022 has recovered over 2021. And really the point that I wanted to make out here is that in January and February and March of 2022, we were unable to get back to pre-COVID levels in terms of rig count in Canada, not because of the demand from our E&P customers, but because of the labor and rig crew situation. So we topped out around 230 drilling rigs here in Canada. Whereas pre-COVID, before March of 2020, and COVID kind of shut down the world, we were at around 250 drilling rigs in Canada. So where we are projected to go, though, in my view, for the remainder of 2022, is that the shaded area, which is the 5-year average, we are very likely going to be at the top of that 5-year average for the remainder of 2022. And you can see that trend happening already in May. Or April 26th here. And so we are probably going to be at the top of that range. So all good news from the drilling rig count perspective in Canada. A little bit about our service rigs. We have 143 service rigs, 75 singles, 54 doubles, 14 slants. As I indicated before, we've parked a lot of these rigs. 78 of them are parked and 65 are active. Those 78 that are parked, I would tell you that roughly 20 of those rigs only require what we call a CBIP, which is a commercial vehicle inspection, and a spend of roughly $30,000 to get them back into service. So not a big spend to get them back into service. The reason they're parked and why we haven't spent them is because we have a shortage of labor in the field here. And it doesn't make sense to go and spend money on a rig if you can't crew it. At 143 service rigs and 65 active rigs, we are the largest service rig company in Canada by operating hour and active fleet. The depth ratings of our service rigs go down to about 5,000 meters. And if one understands what a service rig does, it works on maintenance, workovers, well decommissioning, and our company is focused on the production side of the business as opposed to the completion side of the business. This is a kind of a lifeline chart. You know, how I like to basically talk about the service rigs is if there was ever a consistent work for the oilfield services sector to go back to the same well over and over and over again, it would be the service rig. So so a service rig at the beginning part of the chart there. I don't know if you guys, no, I can't. Can you see this, the pointer? Okay, so right here is where it does a completions job. So basically what happens is that a drilling rig would drill the well, fracking crew or pressure pumping crew would come in, frack the formations to allow the oil or gas to come out. Then you would call in a service rig, which is what we have here, and it would basically lay the pipe down hole and allow the oil or gas to come out of the ground into production. So that's kind of what we call the beginning stage or completion stage. Throughout its life, we have to go back to that same well over and over again because there's going to be sand built up and needs to be cleaned out to optimize the flow of oil or gas into the pipe. So the service rig would do that, change pumps, do all those sorts of things. And so you basically, throughout the life, as the well declines in its production, the service rig goes over to that same well and does maintenance type work. Then this blue chart, when the oil and gas company believes that they have the ability to optimize the well even more, they'll do what we call a workover. So they'll basically do workover work to basically increase the production of that well. And so then that's why the life of the well starts increasing, because it actually, we've done work to basically increase the amount of oil or gas that comes out. And again, we do maintenance work throughout that. So we go back there a couple of times. And so what I like to say is it goes back to the same well about 7 or 8 times for an oil well. At the end of the life of the well, which is the well decommissioning part right here, we go in to basically pull the pipe out of the hole, and then it gets properly cut and capped and puts the land and well back into the same condition it was before it even got drilled. Okay, so if there's ever any reoccurring revenue stream, that would be the service rig side. I wanted to show a service rig hours from 2015 to 2022. Where we are right now is this black line here in 2022. As you can see, we are approaching the top ends of what we have been able to do compared to the 2015 to 2021 era. This was 2020 pre-COVID, and then of course we dropped all the way down. What I'd like to say for 2022 is we are probably mirroring 2029's track now. Now that we have results for April and May, which we'll release here in on July 29th for Q2 results, we know now what our numbers are for April and May, and for April, it was the second highest month from an operating hours perspective, and in May we are slightly less than where we were in 2019. But I do believe that we're going to start tracking this line here going forward. This big line here was just because of acquisitions in late 2017. So right here in 2017, we bought a competitor company, double the size of our service rig division, to be the largest service rig company in Canada. So that was 2017, and that carried forward into 2018, before we had the one-in-a-lifetime event that nobody could have ever predicted, which is production curtailments set by the Alberta government because there was nowhere to put oil into the pipelines. So that's kind of why that fell off in terms of activity level back then. A little bit about the numbers. So we expect now that our 2022 estimate is going to be roughly about 180 to 190 million in revenue. As I indicated previously, the 32 million is probably the low end now. We're probably looking closer to between 32 to 37 million in terms of adjusted EBITDA. And if we end up doing that, it will be a record year for us. It certainly will from a revenue perspective, and from an adjusted EBITDA perspective, I think our previous record year was 2014, where we had $34 million. So 2022 is going to be a record year. Debt level wise, it's coming down. In 2021, as I indicated, we bought those 10 triple drilling rigs, which took our debt level up. We did it with debt at 45 million, and in 2022, we are going to a debt level around $32 million. This is a chart I'd like to show, which basically shows the trailing 12-month revenue and adjusted EBITDA by quarter. The line chart is the revenue, or sorry, the bar chart is the revenue number, and the line chart is the EBITDA number. You can see graphically that these are going to be record years. Every quarter we're getting better, replacing the 5th quarter out. So it kind of shows the growth profile of CWC going forward. A little bit about the CapEx spend. We have a budget of just under $10 million here. Almost $7 million of it is for maintenance CapEx. and 3 million is for growth CapEx. We are actively looking at more acquisitions, and I would suggest to you that 2022 will have some acquisitions to them. So stay tuned on that. So what are we going to do with our cash? With 32.4 million, as I said, was at the light end. 3 million is going to be used for interest expense on that debt. 10 million for the CapEx leaves us some free cash flow of 19.3 million. As I alluded to already here, we are looking at some acquisitions. So we will be using some of that 19.3 million for acquisitions, but the remainder of that will be used to pay down our debt that we incurred to buy the 10 triple drilling rigs, which I kind of think will be paid out in just over a year in terms of the great price that we bought. And that'll be all accretive to our equity holders or shareholders. As ESG is pretty important these days, we talk a little bit about our ESG. We will be putting out a new ESG report here in 2022, probably later this month. But I wanted to highlight some of the things that are already that we put into our 2021 ESG profile, and we did use the CWC framework for oil and gas services for that. 17% of our revenue was work on well decommissioning, which basically is to clean up the environment after the oil well's life is over with our service rigs. 2% of that revenue was on non-oil and gas related activities. So basically carbon capture wells, helium wells, and saltwater disposal wells by our drilling rigs. We are very excited to do our first lithium well here in Alberta. The rigs will start moving here this weekend, and we should be drilling next week, saving except for the wet weather conditions that we've had here this week. But it will be the first lithium wells in Alberta to be drilled, and we're very excited to be part of that project. You'll probably hear about it over the course of the next couple of weeks as we're trying to get the, along with our customer, trying to get the Minister of Energy out to the site to do it, much like the very first Leduc well that was drilled here in Alberta. The safety record of CWC is the lowest it's ever been in 2021 in our 17-year history at 1.22. I would tell you that 2022's safety record year to date is even lower than the 1.22. So we are growing, but doing so in a very safe manner and not having safety incidents. And this next point was a surprise to me. We don't normally keep track of nationality in our company, but when we did this report, we went and sent out a survey to find out how many of our employees identified as Indigenous or First Nations. And it was surprising to me that 7% of our employees identified as First Nations. So we believe that we are proud of including First Nations people in our workforce, and continue to do so, and making sure that we treat all groups, First Nations groups as well as minorities, with the same level of respect and opportunity as anyone else. So speaks to our diversity and inclusion and equity piece of our ESG profile. And we will continue to advance these sustainability efforts in our future years, especially in the areas of emission reductions and established goals and targets. And the last slide I'd like to leave you with is how we perform to our peer group of 7 other companies in Canada, which is made up of contract drilling and well servicing companies. You know, you can always pick a point in time, but I thought that we should pick a point in time before the COVID shut down the economy and how we bounce back after COVID. So pick January 1, 2020, which was 2 months before COVID turned the world around. And you can see that share price returns from January 1, 2020 to April 29, 2022 was 195%, which is better than any other contract drilling well servicing company in Canada. And I believe As at May 31, that number is even higher as we closed at 30 cents. So that's so that would be a 200% return on investment. So that would be the end of my presentation. Happy to take some questions here from you, Paul.
Fantastic. Thank you so much, Duncan. I want to remind everybody, if you do have a question, as usual, use the chat function on the side here, and I'll do my best to ask the question. Why don't we jump into a whole bunch of things here that I've got. You stated a little bit about, labor. We recognize that's an issue that a lot of the companies in the space are facing right now. How do you deal with that? Like, how do you improve your access to labor, and how do you sort of crew the crews that you need to take advantage of the demand right now?
Well, we've been very fortunate in that we have a very strong brand and name in the industry. One of the things I'm really proud to say is that none of our rigs were shorthanded here throughout any of 2022, whereas I know for sure that our competitors could not say the same. It leads to what we believe our tagline being quality people delivering quality service, and speaks very highly to that. I won't lie. We could have ran more rigs here this winter. We just couldn't find the crews, and it's not because of the experienced guys. It's because of the lower end guys. So the floor hands, lease hands, that's where the challenge is, and that's a challenge for all of us in this industry, to bring on more young people into our industry that believe that they can have a long-term career on the rigs. As you can appreciate, there's been a lot of bashing of the oil and gas and oil field services sector, and a lot of the young people may have been turned off of this industry, and we're trying to change that narrative and saying, no, if you can make very good money in this industry, and you can make it throughout your lifetime of a career. And so for us, we've got lots of incentive programs out there. The latest here is that we have increased our wages in our company. On May 1, we increased our wages, our compensation in all of its forms, being RSP and everything else, by 17%. So when people talk about inflation, it's real. I can tell you that. Having said that, we're not burdening that from a margin perspective. We are passing that on to the customer, and the customer is paying for that. So for us, we're in competition with other industries, construction and manufacturing and other industries. And we just hope that, the wage increase will help draw people back into this industry.
And are you seeing, is it working? Like, anecdotally, I'm hearing that it is working. So what can you tell us?
It is to a certain extent. I would say that my belief was really that over the summer months, the crews that you already have like to take time off to enjoy themselves, right? With family. They've worked hard all winter. They want to take time off. In part, I looked at the increase as more of a retention program as well as attraction program, so that we weren't going to lose guys to other industries like construction, road construction, or what have you over the summer months, as we often do. We often get guys looking to do something else during the summer. But we knew that we were going to need all these guys back, because we're going to have a bit busier summer than we probably had than winter. With respect to adding more rigs, yes, the wage increase is helping to increase our rig count. Case in point here, we had 10 rigs working on the drilling rig side over the winter. We're now up to 13, and we're moving to 15 in the next couple of weeks.
Wow. Okay.
So if you think about that, you need at least two crews of 5 or 6 guys.
Yeah.
And so you can do the math in terms of how many guys we've been able to add here just in the last couple of weeks.
Yeah. And, I was talking to another company recently, and they were talking about what the cost would be to sort of replace that. If you were to replace a crew, or let's even say, crew a rig, but purchase the rig, get it all up and running from scratch. I mean, that's a significant expense that would be extremely hard to put in place right now. What can you say to that?
Yeah, it certainly is. Adding the next incremental rig out in the field has a high CapEx spend as well as training spend. Over the strategies that we used over this winter was that we put the extra guy out on the rig, burdened the cost on that. And then when we increased the wages for everybody, we removed that extra man and basically added them to the new rig. So we were building our training session for our guys and incurring that cost over the winter. And now those guys are fully trained and can act as a productive member on the rig.
Yeah, makes sense. Let's talk about a few other challenges. You mentioned inflation, and we're hearing about supply chain issues. What are you guys seeing in terms of either of those things? Apart from the labor inflation, we're clearly seeing. I imagine you're facing other inflationary pressures as well.
Yeah, there's no question that many industries are facing supply crunch right now, and I would say that we are no different from that perspective. It has changed the way we look at things that we thought were going to be 2023 CapEx spends that are now going to be pushed up into 2022 CapEx spends. I kind of alluded to some acquisitions that we're looking at. Those acquisitions are going to come with a lot of critical spare components and parts, and we believe that going and doing that and securing those assets is warranted today. I'll give you an example as to some of the things that have happened here this year. So we have a lot of critical spares to make sure that anything that breaks down while the rig is in working can get fixed or replaced timely, because the last thing you want is not able to get a generator going or what have you if something breaks down. So we have a bunch of critical spares that we have in our inventory, one of which is a top drive. Earlier this year, one of our competitors was looking for a top drive because they didn't have one and theirs broke down. The manufacturer of those top drives came to us and asked us if we had one that we could rent to them. That's good money for us. It's just sitting in our inventory, not earning any revenue. And for us, we're saying, yeah, we'll rent it to you. And so that's what we did. And so that's just an example of what's happening in our industry, that our own competitors don't have one, but we have one because we have the foresight to have these critical spares on part. And we're now making money off of that stuff.
That's amazing how tight it is that something like this would happen, where a competitor has to go through a supplier and the supplier turns to
it's irony for sure.
No kidding. So earlier you talked a little bit about pricing, and I found this interesting because and I think it was you that mentioned it to me offline, but the first couple price increases were really to keep up with the inflationary pressures, but now you guys are actually seeing where you can price and increase margins. You're getting some sort of added price increases that are over and above just inflation. Is that correct?
Correct. Yeah, we don't just pass on the labor costs. We also build in burden and other things, as well as some amounts to our bottom line from a margin perspective. And what I would say is, normally with E&P customers, those that have been in the industry long enough would fully understand that they don't like increases at all. And you have to fight tooth and nail to get an increase. I would say to you, 2022 is a much different story. Here's another example as to why it's different. Normally on a service rig, you would have a day, maybe 2 days notice that you need that a customer is looking for a rig in this particular area to do this particular well. During breakup, which is our slow period, because the ground conditions are too soft to move a service rig or heavy equipment on the roads, because you do damage to the roads, and so the counties and the province have road bans. in April, we were being called to ask for rigs after spring breakup was over, and almost begging to have a rig for them in June. So we are now getting lead times of 2 months for a service rig as opposed to a day or two.
Wow.
And that gives you an idea of the tightness of the market and our customers, basically the demand from customers generally speaking that haven't gotten a rig that's been allocated to them by ourselves or any of our competitors.
Mm-hmm.
Right.
That's amazing.
So that's the conditions that we have, and you can appreciate pricing then becomes a much easier discussion on our part with our customers, because they don't care what the price is, they just need the rig.
They need it. Yeah.
Because at $120 oil, you know,
time is money.
Time is money. Exactly.
Exactly. Well, listen. Okay, let's take out your crystal ball a little bit. You're obviously closer to the whole industry as we are. Like how long could this kind of environment stick around, and you know, what sort of things should we be watching out for in terms of, you know, directions of either natural gas or oil or anything that you can think of as far as just the industry in general?
Yeah, so I am of the belief that we have a good several year run, as much as for, you know, you can look out that far, but I think that structurally we have fixed the boom and bust cycles of the past that is notorious to the oil and gas industry.
Mm-hmm.
And the reason I say that is because our customers are now getting the pressure to drive shareholder returns, and they are not grow for the sake of growing sake. Meaning before, when you had $120 oil, you would be, from our customer's perspective, you'd be going and spending every single dollar you can to generate even more money. Mm-hmm. And that would be your operating cash flow, your debt, your equity that you can raise, and putting it down whole, which is very tough on us, because then we would have to ramp up from a people and equipment mm-hmm. perspective. And of course, safety gets compromised in those type of environments. We are not there today. Today, the capital sources have made our customers be very, very disciplined in terms of shareholder returns from dividends and share buybacks. And they are doing that. And you are seeing that right across the North American basin from our E&P companies, who basically mm-hmm. are saying, yeah, we'll increase a little bit, but we're going to be disciplined in terms of returning shareholder returns. I mean, when President Biden says that the profit margins are too high on refineries and generally speaking in the oil and gas industry, and you need to help the consumer here, you know, in part, that's part of what's happening, is that they're not re-spending that down hole. They are giving back shareholder returns, mm-hmm. right? And I think that discipline will mean that we have a longer run than we've had in previous boom and bust cycles in the energy sector. And that's a good thing. From my perspective, that's a good thing. One, we can't staff up even if they asked us to, because the labor force just isn't there. Mm-hmm. And as you can appreciate, coming out of COVID, Canada is more loath to increasing the temporary foreign worker program, where, you know, immigrants that are outside of Canada or North America mm-hmm. would come into our oil patch and work. You know, they're still on the rhetoric of providing jobs for Albertans and Canadians.
Yeah, no, I agree. Earlier you mentioned that you're book solid for the rest of the year. We talked a little bit offline just in terms of sort of length of contract and how you guys are kind of loath to lengthen the contract right now, because how you can keep stepping up pricing because of the demand. Maybe you talk to that a little bit. What's sort of traditional in terms of length of contract? What are you seeing right now, and kind of how far out can you see, how visible is your business right now?
So we know that that our customers are going to continue to drill, but in terms of fixing the pricing, we're only prepared to go out 6 weeks to 3 months in terms of on the drilling side of the business. On the well servicing side of the business, we have 30 days at any point in time to basically go and increase those rates. In particular, the way the master service agreements work, with our customers. There are things on the outside that are outside of our control. So things like input costs, like supplies and labor. If there is an increase on that side, we would put all that stuff on the outside, and they would have to pay for it. Okay. So we're never really, the business model is never really in trouble from a losing money perspective, that the cost structure got too high and you couldn't recover from it from your customer, unless you choose to do that with your customer, meaning you chose to sign a 1-year contract or 2 or 3-year contract with your customer, lock in the rates. And then there's very little recourse for you to basically go and increase that with your customer, even, you know, because and I know that we are at that point in the cycle now, because our customers have been asking for 1 and 1.5 and 2-year contracts, and we are not prepared to do that. So they know that pricing is going to go higher, and they want to lock in. So we've had, you know, the senior producers, the largest oil and gas companies, the CNRLs, the Cenovus's of this world, asking for that here at the end of last year. And if they, you know, if we would comply with them, but we also then increase the pricing well above market rate.
Yeah,
that's what they want, if that's what they wanted.
Right.
So
right, you'll price in the risk that you have to take for
Correct.
pricing. So obviously it go up significantly.
Correct.
No, that makes sense. Now you mentioned M&A a few times. Can you give us a general sense, like if you're looking at things right now, what kind of either what kind of assets or maybe what kind of geography are you looking at? What do you sort of want to bump up in your business?
Yeah. So for us, you know, we have cleaned up our company a lot in the 12 years that I have been at the helm here. We are now down to just contract drilling, so drilling rig assets and service rig assets. Whereas in the past we had snubbing, we had swabbing, we had well testing, we had coil tubing. So we have sold off all of those business units. So for us, I think we are most inclined to be a pure play driller and pure play well servicing company. The regions that we have identified in our strategic strategy sessions of the past is that we want to be diversifying from the Western Canadian Sedimentary Basin, which we did in 2019, and we have grown in 2021. I would suggest to you that where we are headed is probably more diversification into the US than in Canada. Having said that, in terms of consolidating, because the well servicing side, there's 72 players, 72 competitors in total, and six of the competitors have about 55% of the market share, and we would have about 12-13% of that market share. So very fragmented. There's a lot of consolidation amongst those 72 to happen, and I would suggest to you that we don't need 72 competitors in the well servicing space. So you probably, you know, amongst those 6 that have 55% of the market share, I'd suggest to you, you only need 2 or 3 of them out of those 6. And so there is opportunity there for consolidation.
Fair enough. Perfect. Okay, we get a couple questions in. Why don't we take the questions, and then I'll wrap up with some of my questions at the end here. We've got something here. Management have been exercising options at 20 cents and selling shares right away in the market. Do you know why this is happening? Any color on some of that?
Well, you have to appreciate, if you went to our disclosures on the InfoCircs, you can see that it's been some very lean times for us. And if you compare our cash comp to our competitors' cash comp, that they are looking to basically get some of that compensation back. I mean, we use stock options and RSUs to incentivize our employees, especially our executive team. But you take a look at how much they got paid from a cash perspective, and it wasn't much. So that's probably part and parcel of the exercises and then the disposition in the marketplace. I'd suggest to you that we're one of the most underpaid management teams in the industry.
Yeah. I'd also, there's been other companies that we've spoken to that have said the same sort of thing. And what needs to be appreciated is that, the industry's gone through some pretty lean years, and the ability to finally get some liquidity or get some cash out with all, like what you said, the sort of the lean compensation. I think it just makes sense that the minute somebody gets an opportunity, they do that and they go back to work. So.
And I'll just add this for those who are looking at that type of stuff. I never get the question on why guys are. I always get the question of why guys are selling, as opposed to what, I never get the question of, well, those guys exercise their options and RSUs. And so whenever I end up selling, people don't appreciate that I have a cash tax that I got to give to the government every time I exercise those RSUs and options.
Yeah.
So I have to come up with that money. And if you actually do the math and go, okay, this guy gets 52% of after-tax dollars. So my disclosure on salary is disclosed. So I get 52% of that. I'm spending over 70% of that salary exercising my RSUs and options, of which then I have to go and pay the tax right away before I even get there. So where am I supposed to get that cash from, guys?
Yeah, I can attest to that. I personally had to do the same thing. So I appreciate what you're saying here for sure. Okay, next question we've got is, okay, do you take any steps to lower methane and CO2 emissions?
The quick answer is yes. We have already identified that we are going to need to set some targets for ourselves in terms of our ESG profile. The difficulty thing here is, so I'll give you an example. Tier 4 engines are a more efficient engine on their rigs. We have tier 2s and 3 type engines on most of our service rigs right now, but tier 4 takes that to another step. Those engines are around $300,000 each. We originally in our 2022 CapEx budget had 4 planned engine replacements of tier 4s, and then we cut that back to 1. And the reason why we did that was because we wanted to see what the emissions profile would be for our customers, because you're talking about not just scope 1 for us, but also scope 1 and 2 emissions and scope 3 emissions for our customers. And so one of the things that notoriously we do in our industry is that we develop all of these things that are nice to haves and are good to haves and need to haves, but our customers take it for granted over time and stop paying for it. We can't let that happen on reducing emissions. They're the ones asking for the activity, and there has to be a pass through. So we're going to go and do this with the 1 tier 4 engine on our service rig that we're doing here right now. We are then going to upsell that to those E&P customers that want to be leaders in terms of having a higher ESG profile, and they're going to end up paying for it. And there needs to be a recognition that E&P side has to pay for this, because they're the ones generating the emissions in the first place by looking at drilling a well.
Yeah.
Right.
Yeah.
So then the other aspects of it is, yes, the biofuel, converting from diesel to natural gas and using natural gas on site for a drilling operation. Those things are happening. We've made the investments on that side. Again, one of the challenges when you're not all exclusively with just one customer for one rig is that you can build that onto your rig. You have that option, and then the next customer says, yeah, I don't need that, or I don't want that. So you have to build the CapEx cost and recovery of that CapEx cost on a timely basis with the customer. And so there's only certain cases where that would make sense in terms of the work that you have with any particular customer.
Fair enough. Fair enough. And then the last question here is, does the company have targeted utilization rate?
Do we have a target utilization rate?
Yeah, 100%.
100%. But that's not realistic, right? So I would just point to you that our utilization rate from our drilling rigs, we publish that every quarter, compare that to the CAOEC, and we're usually always about 20% higher from utilization rate than our customers. And that has been our history throughout all that time. It speaks to the service that we provide, the quality of our rigs, and the customers that are our customers that basically keep coming back to us as opposed to the competitor. That we run a really good show. So, one of the things I'm most proud of is we were 7 of 7 drilling rigs in Canada here this winter. Nobody else can say that of our competitors.
So well above average utilization
rates. Well above average
yeah.
Utilization rates, yes.
Fantastic. Okay, I lied. There is another question here, and I'm going to ask it and then sort of make a sort of statement along with it. But it says, with limited drilling by oil companies and manpower shortages, it sounds like there could be a point where revenue levels off. Is this correct? If not, why? And if so, what point could this happen? Now, my belief in this and why I like the energy services space so much is that there is a sort of shortage and call it a supply shortage of service companies. And one of two things is going to happen. Either, the producers, get busier and are still going to suffer the shortages of services, or the price of oil and gas go higher, and that's going to increase their need for oil and gas service companies. So to me, I think the real challenge in the industry is not so much demand, but it's this ability to sort of keep up and supply demand on an ongoing basis. How do you comment to that? What are your views of, does revenue level off for you guys, or does it go higher based on what you know?
I don't think revenue levels off. I think that the tightness in terms of the supply situation for our customers because of labor means that the pricing continues to go higher. Those who aren't getting a rig, and it's not that those guys are going to stay static. They're growing. It's just that they're not growing at the same levels that they used to grow at in terms of pace. Before, they just spent every dollar that they had, whether it's equity, debt, or cash flow, operating cash flow, downhole. That's not happening anymore. So it's going to come at a measured pace, but that growth is happening, and revenue continues to increase. I mean, you just need to take a look at our numbers and basically say, okay, from a gross number perspective, we're back to 2014 type numbers, but from a real dollar perspective, we're not even back to 2014 type numbers. We still have more to increase from a real dollar perspective. Nominally, it's back. Real dollars, it's not. But we will get there by the end of this year, right? It's just that our customers need to start appreciating that 7 years worth of inflation needs to be caught up, right?
Yeah.
So that's kind of where we're at, and labor force will come back. There will be people will always find a way to get that labor force back when they need it, right? The trick for us is to basically convince them, that labor force, that this time it's different, that this time it is sustainable, and you're not going to be without a job in 2 years' time.
Right.
Yeah.
It's another question just came in here. It's in regards to what happens during a recession, but I really think I'd almost say this time is different in that we're dealing with sort of a market of its own. Like you guys are driven more by what happens with the price of energy and North American energy, because I think there's a whole level of energy security and security of supply now that comes into the picture. So, going into a recession, clearly I think we're going to see an economic slowdown, but that may not mean that energy prices or energy demand is going to go away for you guys. How do you comment? What happens if we go into a recession? What do you see?
I actually think that if we do go into recession, for us, it won't be as big an issue as, say, other industries. And the reason I would say that is because that's temporary. Like when we talk about recessions, we're talking about a year, 18 months, something like that. But structurally, what we have fixed in our industry from a capital discipline perspective and demand perspective, if you believe that it is energy transformation as opposed to energy transition that many talk about, and when I say energy transition, I'm talking about renewables and sustainable energy sources. It is not my belief that that in and of itself is going to be enough for the consumption of energy. I believe we need all sorts of sources of energy, including fossil fuels. And the reason I say that is if you look out to 2050, how many more people are going to be born in this world? Like it's billions, and many of them are going to want that middle class lifestyle. And that means that all these energy sources, they're all in need. The difference is that we in this industry, the oil and gas industry, are going to start dealing with the emissions profile of carbon and methane, right? And we are spending a lot of money, or at least our customers, as well as ourselves, are spending a lot of money trying to find those solutions and create those solutions that we would have a long life in history, right? And so in my belief, even if you hit a recession, it's going to be short-lived in terms of timing from a big picture perspective, but that oil and gas will continue to grow. And I don't think that we've hit peak oil or gas yet. And we won't for quite some time, at least well beyond my lifetime or beyond my working lifetime.
Yeah, I completely agree. Okay, last couple of questions in regards to just the stock or kind of the capital market side of things. I imagine you were probably not getting a lot of phone calls, a year ago from investors. But maybe give us a sense. What are you seeing now? Your phone's ringing a little bit more. Are analysts calling? Are investment bankers trying to throw you money? What's changed over the last little while?
Yeah, I would say that the investor relations has ramped up. It's taken a lot more of my time than say last year at this time. The interest level in energy has increased significantly from an investor perspective. I think that you've seen that from our customers in terms of their share prices and the run that they've had. Oil field services companies, in particular the Canadian energy services industry, haven't run as hard as say our customers have. And therein lies what I believe to be the risk return profile for taking a look at the oil field service sector, and in particular for my company, CWC, where the opportunities are from a risk return perspective. I mean, we've demonstrated throughout all those years that we're good stewards of capital. On the downside, we've done a ton of cuts through COVID and even before COVID, to the point where we're extremely lean, and that's starting to show in our numbers in terms of margins. The margins are starting to increase. The cost structure has been cleaned up as much as you possibly can. I mean, we're adding to that cost structure now because our activity level is increasing, but we're still being extremely disciplined. And I think that 7 years of a downturn in the Canadian energy services sector does that to you. And so I think that there's only upside here in terms of opportunity. And from a share price perspective, an investor's perspective, taking a look at the oilfield service sector and in particular CWC in terms of our fundamentals, it's getting better. Like I said, 2022 most likely will be a record-breaking year for revenue and perhaps even adjusted EBITDA. Yeah,
fantastic. I just, my note here, I took down that you managed to buy 10 rigs at the cost of 8.5 cents on the dollar. That's discipline to be able to do that, and hopefully you can find a few more of those type of deals. That'd be great.
I think the timing was perfect on that one.
I can imagine. Yeah,
the next one won't be as great, but it'll still be good.
That's awesome. You gotta be lucky to be good sometimes. Absolutely. Listen, that kind of gets us where we want to go. What we always like to do is give you an opportunity to sort of give a key takeaway or key message you want to make sure everybody walks away with today. Duncan, what do you really want to make sure that everybody knows about CWC?
Yeah, I would suggest to you that take a look at the track record, take a look at the risk return, even if one was to invest here today at these levels, what the downside risk is versus the upside potential. You know, our company has a very big shareholder, but that big shareholder has been extremely supportive of our name throughout all these years. They were first in our name in 2006, so they're still here through all of that. So the downside risk, in my view, is very minimal, but the upside potential can be huge. And it doesn't take much from an investor perspective in terms of number of people interested in this name. And if you want some exposure to this sector, that this should be a name that you look at versus, say, larger competitors of ours in this space, that are much more widely held and would have more ups and downs in terms of the share price. And we've demonstrated that with our last slide here.
Yeah. No, and I definitely agree. I think that's something we've been pounding the table on quite a bit, is that you want to look at the smaller providers, and we've circled you guys because of what you guys have done over the last little while, and the fact that you're still relatively undiscovered amongst the investment community. So, I completely agree with what you just said there.
Actually, one last thing, if I might, Paul.
Please.
What I'm really proud about during this whole downturn, and this goes to speak to the fundamentals of our company and how we manage our business, and always watching the dollars and cents. There's only been one quarter since the downturn in 2014, late 2014, where we had negative adjusted EBITDA. Every other quarter we have been positive adjusted EBITDA, and we have had positive cash flow. It was a broken record to say that during the cannabis run, during the tech run. But we are proud to say that from a fundamentals perspective, we didn't lose anybody any money. Yeah. Like we managed our business every time we turned a wheel on the service rig, every time we drilled a well on the drilling rig, we were making money. And you can guess which quarter that was where we lost money.
Sure.
Q2 2020, when nothing was working in the world.
Absolutely. When everything was frozen solid. Absolutely. That's amazing. Actually, that's I would never have expected to know that. But I think that,
and what I will say is none of our competitors are in the same. Yeah, not a single one of our competitors can make that claim.
Yeah, that's extremely impressive. And a very good point to end on. I think that speaks volumes about how you guys are running the business, and congratulations on that. So listen, we've been speaking with Duncan Au, CEO of the CWC Energy Services. The symbol is CWC on the Venture Exchange. Duncan, listen, it was great catching up with you, and we certainly look forward to catching up with you in the near future as well.
Thanks, Paul. Thanks, Trevor. Thanks, everyone.
You got it. Thank you.